Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Servicetitan Inc. Annual Report. Servicetitan Inc. offers a wide range of business solutions for various industries. At the core of their services is the Servicetitan platform, which connects and manages multiple workflows such as advertising, job scheduling, dispatching, estimating, invoicing, and payment processing. In addition to the Servicetitan platform, the company provides specialized software for specific trades, including FieldRoots for pest control, Aspire for landscape and clean industries, and Convex for sales and marketing in the trades. These platforms offer real-time reporting, precise data, and accurate job costing. The company also offers fintech products that include payment processing and third-party financing solutions. This allows businesses to streamline their financial operations and provide customers with flexible payment options. Servicetitan's services cater to a diverse range of industries, including HVAC, plumbing, electrician, pest control, landscaping, lawn care, roofing, air duct cleaning, and many others. By providing end-to-end cloud-based software platforms, Servicetitan enables businesses to manage their operations more efficiently and effectively. Servicetitan Inc. maintains a market capitalization of $6 billion, broadly in line with the industry peer group. Servicetitan Inc. trades at a higher price-to-book ratio of 3.91 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 18% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company are multifaceted. Revenue streams play a crucial role in determining the trajectory of revenue growth. The company's reliance on subscription contracts, usage-based fees from payment transactions, and fees from third-party processors for payment and financing services contribute significantly to its revenue growth. Additionally, sales of pro products on a usage basis, such as direct mail services, also contribute to revenue growth. The company's revenue growth rates are impressive, with platform revenue increasing by 26% year-over-year, YoY, in fiscal years 2024, 2025, and 2026. Professional services and other revenue have also shown a steady increase, albeit at a slower rate. The significant increase in accounts receivable and deferred contract costs indicates potential revenue growth, as these figures are indicative of future revenue streams. However, the primary drivers of cost of revenue growth or decline are different from those of revenue growth. Personnel-related costs in professional services and other cost of revenue, sales and marketing expense, research and development expense, and stock-based compensation all contribute to the company's cost of revenue. These factors must be carefully managed to ensure that revenue growth is not offset by increasing costs. The company's contract assets have also increased significantly, indicating potential revenue growth. Furthermore, significant tax credits and net operating loss carryforwards can impact revenue growth or decline. By understanding these various drivers of revenue growth or decline, the company can make informed decisions to optimize its revenue streams and manage its costs effectively. The net income and profit margins of the company underwent significant changes between fiscal years 2025 and 2026. In fiscal year 2025, the company reported a net loss of $239.1 million, which improved to an implied net income in fiscal year 2026 due to increased other income and decreased general and administrative expenses. However, this improvement was short-lived, as the company reported another net loss of $169.2 million in fiscal year 2025. The non-GAAP net income for fiscal year 2026 is not provided, but it is clear that the GAAP net loss persisted. On a more positive note, the profit margins showed an increase. The total gross margin rose from 65% to 70%, while the platform gross margin increased from 73% to 77%. Additionally, the general and administrative expense as a percentage of revenue decreased from 28% in fiscal year 2025 to 26% in fiscal year 2026. The reasons behind these changes are not explicitly stated, but it is likely due to various factors such as decreased revenue, increased expenses, or other business operations. Despite the improvements in profit margins, the company's net income and overall financial performance remain a concern. The company's financial performance is a notable aspect of its overall health. A key indicator of this is the generation of positive operating cash flow. According to the provided information, the company has consistently demonstrated this trend over the past 2 years. In 2025 and 2026, the net cash provided by operating activities was $37,053,000 and $110,131,000 respectively. These figures are significant as they indicate a substantial increase in positive operating cash flow from one year to the next. This upward trajectory suggests that the company's operations are generating sufficient funds to cover its expenses and invest in growth initiatives. The consistent generation of positive operating cash flow is a testament to the company's ability to manage its finances effectively. It implies that the company has a solid foundation for future growth and can continue to invest in its business without relying on external funding sources. Overall, this trend bodes well for the company's long-term prospects and provides confidence in its financial stability. The company's debt level and interest expenses have undergone significant changes in recent years. According to the extracted summaries, the long-term debt has decreased significantly from $104 million in 2025 to $0 in 2026. This reduction in debt is reflected in the decrease in total liabilities by $94 million. As a result of this debt restructuring, the company's interest expenses have also decreased substantially. The interest expense decreased from $16.4 million in 2023 and $15.5 million in 2024 to $7.2 million in 2026. This represents a significant reduction of $8.3 million due to the repayment of the revolver facility. The decrease in cash paid for interest expenses is also noteworthy, with a 57% reduction from 2025 to 2026. Overall, these changes indicate that the company has successfully managed its debt and reduced its interest expenses, resulting in improved financial performance. The management of this company is optimistic about its outlook, driven by a growth strategy that involves expanding into new trade verticals, retaining existing customers, and investing in research and development. The company expects to increase revenue as more users adopt its platform and product offerings, but also anticipates higher costs due to increased sales and marketing expenses. To achieve this growth, the management has implemented restructuring efforts, including reducing workforce in certain areas, which will help align investments with strategic priorities. Additionally, the company is focused on improving financial flexibility by repaying debt and reducing costs. While there are potential risks such as changes in interest rates and inflation, the overall outlook remains positive. The company's strategy is centered around innovation, investment, and research and development, which will drive growth and improve its competitive position in the market. By prioritizing financial flexibility and reducing debt, the management aims to create a strong foundation for future success. There is no mention of acquisitions or divestitures in the provided report. The absence of any transactions related to buying or selling assets or companies suggests that the company's focus has been on other aspects such as operations and strategy development. As a result, there are no notable acquisitions or divestitures to highlight. The company's financial activities have been focused on share repurchases rather than dividend payments. One notable instance of this was when it redeemed all outstanding shares of non-convertible preferred stock for $310.6 million. This significant investment in buying back its own shares indicates a strategic decision to prioritize shareholder value through equity reduction, rather than distributing profits as dividends. That concludes the financial summary for Servicetitan Inc. Feel free to comment below, and I will be happy to answer them when possible.